More and more companies are staying private for longer. This is locking out the average investor from realizing gains in these next gen startups. Robinhood recently announced the launch of their own private fund called Robinhood Ventures I, trading under the ticker symbol RVI, with the aim of bringing private investments to the public market. I'm Matt Bremer, owner and wealth advisor at Queen City Wealth. I help individuals and families make smart decisions to prepare for retirement. If you find the video helpful, be sure to like to follow along, and you can reach out directly if you're interested in working together. Right now, some of the most valuable companies in the world are private companies and do not trade on the public stock market. For example, SpaceX is valued at $1.4 trillion. OpenAI is valued at $840 billion. Anthropic is valued at $380 billion. Stripe at $180 billion, and Databricks at about $135 billion. All of these are private companies not available to the average investor. Compare this to Google that IPO'd in 2004 at $23 billion and now has a market cap of $3.6 trillion. Apple IPO'd at just $1.8 billion in 1980, for example, and now has a public market cap of $3.6 trillion. At the time, Facebook had the third largest IPO at $104 billion, and Meta is now valued at $1.5 trillion. This is 10x from its IPO, and investors have had several opportunities to buy lower. Investors had plenty of chances to buy into these companies and appreciate significant wealth creation along the way. But now these companies are staying private for longer, and until they IPO, the average investor is locked out from these gains. Earlier this month, Robinhood IPO'd their closed-end fund, Robinhood Ventures I, with the goal of offering retail investors access to these private investments. The initial investments from the fund include Databricks, Mercer, Ramp, Airwallex, Boom, Aura, and others. Databricks is valued at $140 billion. Mercor is valued at $10 billion, Ramp at $32 billion, Airwallex at $8 billion, Boom is valued at $1.5 billion, just after raising $300 million in December of 2025, and Aura's latest valuation was $11 billion. As of last week, Robinhood announced they have invested in Stripe and 11 Labs. This is what's in the fund, but now let's talk about what you get when you buy the fund. Robinhood Ventures is a closed-end fund and raised over $600 million in its IPO. The fund is considered a closed-end fund, which is similar to ETFs, but different from your standard mutual funds, which are open-ended funds. The difference is that for a closed-ended fund, like an ETF or this Robinhood Ventures fund, the stock and the price or valuation of the security is not directly tied to the underlying securities. Whereas of your typical mutual fund that is open-ended, at the end of the day, the price of your shares will reflect the total ownership of the underlying securities. It is possible for the price of RVI, the Robinhood Ventures Fund, to decrease in value while the underlying securities increase in value. And since the underlying securities of the fund are illiquid and do not trade on public exchanges, there will most likely be some volatility swings in the security. There are only updates to the valuation of the underlying companies when they raise funds from other private investors. It's important to note that when you buy shares of RVI, you're just buying a share of the security, and you do not receive any shares of the underlying companies that they are invested in. Those securities are owned by Robinhood Ventures. The good news is that since RVI shares trade on the public exchange, it is a lot more liquid and easier for the average investor to buy or sell their shares. Oftentimes, for private funds that invest in these private securities, sales are limited to 4 times a year on a quarterly basis, and the funds will limit the amount of redemptions per quarter. It can be hard to sell these types of private securities, and compared to RVI, which provides liquidity every day. Here are a couple things that you should know if you're considering an investment in the Robinhood Ventures Fund. Robinhood's own disclosure plainly states an investment in the fund is speculative and involves a high degree of risk with substantial risk of loss. The fund is highly concentrated in technology companies, payment fintech companies, and AI-powered companies. Any of these securities may make up to 20% of the fund holdings at purchase. It's likely that the share price will drop significantly compared to the valuation of underlying securities if even one of the companies has negative news or does not perform as expected. Robinhood has said that they plan to hold these stocks through IPO, but it is not given when that will be. Investors could be waiting a while for any of these stocks to IPO. The other thing to be aware of is that RVI has an expense ratio of 2%, meaning you'll be charged 2% of your holdings throughout the year. The fund has waived part of that fee to 1% for this first 6 months of trading. 2% can be considered a high fee, but there are not many options available for the average investor to access these kinds of investments. It does compare better to private investments, which can have a 2 and 20 fee. This means that the private fund manager will charge 2% annual fee and a 20% performance fee. So for example, if the Robinhood fund charged 2 and 20 and had an asset value of $600 million, then appreciated for a 10% gain of $60 million to $660 million, they would charge 2% and 20% on the $60 million gain, which would be $12 million. The good news is that there's no performance fee included in the Robinhood Ventures Fund. I think it is exciting that Robinhood is considering how to provide investment options to the public market. As discussed in this video, there are a lot of positives. It provides late-stage exposure. These are established startups with real revenue, not seed stage bets. It provides liquidity, unlike traditional private equity. You can buy and sell shares on a public exchange, and it also provides recognizable names. The portfolio reads like a who's who of high-growth private tech companies. These investments are real companies that are generating revenue today. Some of the negatives include valuation uncertainty. Private company valuations don't update daily like public stocks, which can create pricing gaps. There's also the fee drag, where the fund carries the 2% expense ratio. It is currently discounted for the first 6 months. There's also concentration risk. It's a relatively small number of holdings, so a single company setback hits harder to the portfolio. There's also the speculative nature of it. Even well-known private companies can fail to deliver on their valuations at IPO. My take is that RVI is a genuinely interesting product, and it represents a real way for retail investors to access private investments. But interesting and right for your portfolio are two different things. The closed-end structure, fee load, and limited investment options all deserve careful considerations before you buy. If you're wondering whether something like RVI has a place in your financial plan, I'd love to talk through it. Feel free to DM me or book a complimentary 30-minute consultation.